Okay, so let's continue. In our previous class, we looked at how to prepare a group statement of cash flow, but that time we only looked at the format. Today we want to do a question. In applying what we learned last time. So, but before we do the question, so let me introduce or remind you a few things which you must have done before when it comes to questions of cash flows. Normally, anytime you're given a question on cash flow, the examiner will give you the income statement for that particular year. He will also give you some two statements of financial position. One for the previous year, which I want to assume our previous year, I'm assuming was the year 2010, and our current year, I'm assuming was the year 2011. Now, every time you're given a question on cash flow, the first thing to do is to go and analyze every item. Go analyze every item in the statement of financial position, seeing how those items will help you to prepare your cash flow statement. I have said every time you're given a question on cash flow, whether it was in section 1 or in section 3, financial reporting, it doesn't matter. The procedure was the same. Even now at this level of section 6, we still apply the same process, whereby we are saying, go analyzing every item that you are given in the balance sheet, seeing how that one item will help you to prepare your cash flow statement. For example, when you are given debtors, which are also called trade receivables, why do you need to analyze those debtors? Of course, you need to know whether there was an increase or decrease in debtors. If you are analyzing the stocks, you want to know, was there an increase or decrease in stocks? That's what you want to know. If you're analyzing the debentures, for example, you want to know, could we have repaid our debentures or could we have issued more debentures? If you're analyzing share capital, you want to know, did we issue more shares this year? So the point I'm trying to say is, every time you're given a question on cash flow, you must analyze every item that you're given in your balance sheet, seeing how, then you find out how will it help you to prepare your cash flow statement. Now, the only key important point I want to remind you is when you're analyzing the account of the property, plant, and equipment. Let us assume the examiner has given you the name of their fixed asset as property, plant, and equipment. But we are saying it can be any other fixed asset. Whatever the name. Now, when you're analyzing the account of the property, plant, and equipment, get the point now, that is the only issue I want to emphasize on. That when you're analyzing the account of property, plant, and equipment, what is it that you are looking for? I have said, for the other things, you know what you are looking for. For stocks, you need to know whether there was an increase or decrease in stocks. For debtors, you need to know whether there was an increase or decrease in debtors. For share capital, you need to know whether you could have issued new shares this year. For debentures, you want to know whether you repaid your debentures or you issued your debentures this year, or you issued more debentures. But when it comes to property, plant, and equipment, now the point is, when it comes to property, plant, and equipment, sometimes it's not obvious what it is that you are looking for. And so we need to know what is it that the examiner sometimes can hide from you when it comes to property, plant, and equipment. Normally, there are some three things that the examiner may not give them to you when it comes to property, plant, and equipment. And one of them is the cash that the company could have paid this year to acquire new fixed asset. You know you need that amount of the cash paid to acquire new fixed asset in your cash flow statement among your investing activities. Alternatively, if it gives you the cash paid, some questions don't give you what is the depreciation charge for the year. And so you may be required to calculate it, and you need it again in the cash flow statement among the non-cash items. You know that sometimes it doesn't give you depreciation charge. Then another thing that the examiner sometimes does not give you is the net book value of the asset disposed, the net book value of disposal, net book value of any disposal. For example, if I may give you If sometimes you're given, according to the question, among the additional information, some questions tell you during the year, the company sold a motor vehicle, costing shillings, maybe 50 million at a profit of shillings 10 million. If the examiner gives you that additional information, maybe it tells you during the year, the company sold a motor vehicle costing 50 million at a profit of 10 million. Of course, there was a disposal. And you know, among your investing activity items in the cash flow statement, there you need to come and say sale of motor vehicle. If I may ask you, remind me on how much, it will tell me, if the examiner gives you that during the year the company sold a motor vehicle costing 50 million at a profit of 10 million, how much were you taking to the cash flow statement as the cash received? How much were you taking to the cash flow statement as the cash received from the sale of machinery or motor vehicle? Obvious, when you are given this kind of a statement, there is no way you can know how much you sold the motor vehicle for, because this is a vehicle you bought at a cost of 50 million many years ago. You are selling it this year and making a profit of 10 million. So it is not possible to know how much you sold it for. Don't confuse and say you sold it for 60 million. No, you don't know how much you sold it for. Why? Because this is the cost of the asset many years ago, but you are selling it this year at a time when you're selling this year, you're selling it and making a profit of 10 million. So what you need to know concerning this motor vehicle, before you know how much you sold it for, you need to know what is the net book value of the motor vehicle at the time of disposal. What is the net book value of the motor vehicle at the time of disposal? And that's what I was saying. Some questions don't give that net book value to you. So if the examiner gives you this kind of an additional information, then it is obvious, therefore, that you will need to calculate the net book value. You will need to calculate the net book value of the asset disposed. So these are the three things which sometimes the examiner may not give them to you. Now, we now go on. The other issue I want to mention is this. Some of your past papers may not give you one of them from the question. Maybe the examiner gives you the depreciation charge for the year, the examiner gives you the net book value of the asset disposed, and he doesn't give you the cash paid to acquire new ones. So if you are not given one of these, what do you do? When you're not given one of them, then you will need to prepare the account of the property, plant, and equipment. But that account that you prepare, remember, you must maintain it at its net book value. That's what I know you know from your previous classes, whereby go to the question, find out anything concerning property, plant, and equipment, and then feed it in. There will be a balancing figure now, which will represent the cash paid to acquire new ones. For example, go to the balance sheet last year, find out what was the book value of the property. Maybe during the year, we revalued some more property upwards, and you find out what was the increase in the revaluation. Maybe we revalued our assets upward by whatever the amount. Maybe during the year, we disposed of an asset. And when you are disposing, you remove it from the account. But the other point is, if you have to remove it, remember to remove it at its net book value. Why? Because we are maintaining this account at its net book value. So you remove it at its book value. Then you come and remove the depreciation. Of course, you know depreciation charge for the year reduces the value of an asset. Once you do that, then you will carry down the balance by the end of the year. Whatever balance the examiner will give you by the end of the year from the balance sheet. Then whatever will be the balancing figure now, that will represent the cash paid to acquire new ones, and we are saying you get it as a balancing figure. So that's how we determine the cash paid to acquire new ones. Or it could be that the examiner has given you this cash paid. What he does now not give you is the depreciation charge for the year. So if he does not give you the depreciation charge for the year, but he has given you the other two items, again, you still prepare the account called property, plant, and equipment. Again, you prepare it on the basis of the net book value. This time, we don't know the depreciation charge for the year. This is now what you will get as a balancing figure. That's what you now get as a balancing figure. Why? Because this time you will have known the cash paid to acquire new ones. The examiner would have given it to you. The examiner would have also given you the depreciation charge and the net value of the asset disposed. So you will get this one now as a balancing figure. You now get it as a balancing figure. That's what we are saying. If it does not give you the net book value, like the illustration I was trying to show you before, where he never gave you the net book value, he only gave you the cost. So what you needed was the net book value of that motor vehicle, you remember. So if it does not give you the net book value, it automatically then he could have given you the depreciation charge for the year. So you will fill in again everything. You will fill in again everything. Then the only missing item now will be the net book value of the asset disposed. Now you get it as a balancing figure. You now get it as a balancing figure. So my point is, when it comes to fixed assets or property, plant, and equipment, we are saying the examiner sometimes does not give you one of these three things. So when it comes to cash flow question, the first thing you must ask yourself, which one have I not been given? In other words, have I been given a cash pay? Maybe yes. Have I been given the depreciation charge for the year? Yes. Maybe have I been given the net book value? Maybe no. So if they don't give you the net book value, get it this way, as we have said, or any other, you get it as a balancing figure in the account called property, plant, and equipment. But there are questions whereby the examiner may not give you two of these items, two of them. One, maybe he does not give you the cash pay to acquire new ones, and two, he does not give you the depreciation charge for the year. So in other words, if he does not give you two of these items, then it is not possible to determine two things as a balancing figure in one account. If it does not give you one of them, then you can't use the account called property, plant, and equipment on the basis of net book value. No, you can't get two things. You can't get the cash paid to acquire new ones on this side and the depreciation side on this side. You don't know the cash paid, you don't know the depreciation charge, you can't get them from one account because you have two missing items. So we want to answer the question now. If he does not give you the two things and you want to calculate them, how do you determine those two? If he does not give you, that means if the examiner does not give you one of the two of those things, then most probably he will give you their balance sheet this way. He will give you the balance sheet or the statement of financial position in this manner. He will give you the cost of the property, and then he will come and say here, accumulated depreciation, whatever it is, to give you the net book value. So we are saying, if you find that from your balance sheet or from your statement of financial position, you are given your question this way, then it is most likely that the examiner has not given you two of the three things. And if he has not given you two of them, then it's not possible to use one account. And therefore, that's why he's giving you the information. Now he's giving you on the basis of cost and gives you also on the basis of the depreciation. So what you do, you open two separate accounts. One in the name of property, plant, and equipment. This time you maintain it purely on the basis of cost. And the second account that you prepare is an account called provision for depreciation. And you now use it now to determine. So when the examiner has not given you two of these things, then you must separate the accounts so that one of the accounts will be used to determine one of the missing items, and the other account, we shall use it to determine the other missing item. That's the point we are trying to say. Now, to get the cash paid to acquire new ones, now go to the balance sheet last year, bring down the cost of the property. What was the cost of the property by end of last year, whatever it is. Again, find out, could there have been a revaluation? Maybe yes, we revalued some of our fixed assets and maybe we revalued them upwards. Go find out what is the value, whatever it is. Then if there was a disposal of an asset, come and remove it. But the emphasis again is the emphasis is remove it now, not at book value, remove it at cost. Initially, in the previous illustration, we removed it at book value. But now that we are maintaining the account at cost, remove it at cost. Then you carry down the balance by the end of the year from the balance sheet, whatever it is that you are given, find out the cost by the end of the year. Once you do that, now there will be this balancing figure, which will now represent the cash paid to acquire new ones, the cash paid to acquire new ones, which you need in your cash flow statement. So that's how you get the cash paid to acquire new ones as a balancing figure in the account of the property, which is maintained at cost. Then, now use the other account to determine the depreciation charge for the year. Again, you feed in all the information concerning depreciation, and there will be a balancing figure. By bringing down the accumulated depreciation from the balance sheet last year or from the statement of financial position, what is the accumulated depreciation last year, bring it down. Then find out from the question what else goes to this account. You know from your previous class or your previous subjects or from your previous accounting that in case there is a disposal of an asset, the accumulated depreciation of that disposed asset, we normally remove it from the provision for depreciation account. You know that whenever there is a disposal of an asset, the accumulated depreciation of that asset is normally transferred from the provision. How? By debiting. So if there was a disposal of an asset, find out what was the accumulated depreciation of that asset disposed. Then once you are through, then carry down the balance by the end of the year. Carry down the balance by the end of the year, whatever it is. Once you carry down the balance by the end of the year, there will be now a balancing figure. There will be a balancing figure. That balancing figure will now represent the depreciation charge for the year, which normally goes to the P&L account. And because the examiner had not given it to you, that's how you get it. So I have emphasized that there are questions where the examiner does not give you two of these things. And if it does not give you two of them, that's how you determine. You prepare two accounts so that one of them will help you get one thing, the other account will help you get the other missing item, So I'm through now with the emphasis of the property, plant, and equipment. And that is one of the major workings whenever it comes to cash flow statement. That's one of the major workings whenever it comes to cash flow statement. So with that idea now, I have said every time you're given a question on cash flow, go analyzing every item in your statement of financial position, seeing how it will help you. I have said all the other things, you know what you are looking for. All the other things in the balance sheet or in the statement of financial position, you know what you are looking for. What we don't know is for the property, plant, and equipment. Why? Because that may not be obvious. We have said there are three things the examiner may not give you concerning property. Of course, I hope you remember them. We have just said cash paid to acquire new ones may not be given to you. You need that amount maybe in the cash flow. Another thing we have said is the depreciation charge for the year, and the other one is the net book value of the asset disposed. So if there was a disposal, they may not have given you the book value of the asset disposed, so you need it. So from the cash flow questions, find out whether you have been given all of them, or have you been given one of them, or have you been given two of them, whichever the case might be. But as far as cash flow is concerned, from the property point of view, you must find out whether they are giving you any of those three. So with that idea now, let's do the question that I want us to do. And so the question I want us to do is from your past papers, and the question is a question of November 2015, is a question of November 2015, and it's a question number 3. It's a question number 3. That's the question I want us to do, November 2015, question number 3. For now, my emphasis is only on part B, so which says, Mawingo Group has prepared the following statement, the following financial statements for the year ended 31st October 2014 and 31st October 2015. So you are given the income statements there. In that income statement, there is revenue, cost of sales, gross profit, income in terms of share of profit from associate. Then you have investment income, you have admin expenses, you have distribution cost, you have finance costs, you have profit before tax, you have taxation, you have profit for the year, then you are given profit attributable to, then on controlling interest and controlling interest. Then on the other side, you are given also two statements of financial position, one for last year, 2014, and the other one for this year, 2015. Among the non-current assets, there is property, plant, and equipment. Then you have intangible assets, including goodwill. Then you have investments in associate. Then you have other investments. Among the current assets, you have inventory, trade receivables, financial assets at fair value. Then you have cash in hand. Then you are given capital and liabilities. Among them is ordinary share capital, share premium, revaluation reserve, retained profit. Then you have non-controlling interest. Then among the non-current liabilities, we have debentures. Among the current liabilities, you have trade payables, trade accrued expenses, bank overdraft, and taxation. Additional information. Number one, some item of machinery with an original cost of 680 million and a net book value of 360 million was sold for 256 million during the year ended 31st of October 2015. For the following information relates to property, plant, and equipment. You are given a column for 2015 and a column for 2014. You are given cost, depreciation, and book value. Number two, during the year ended 31st October 2015, Mawingo Group acquired 80% of the share capital of Mwewe Limited. The net assets of Mwewe Limited were as follows as at the date of acquisition. So you're given property, you're given inventory, you're given trade receivables, creditors, you're given trade payables, you are given bank, taxation. Number three, the cost of property, plant, and equipment of Mwewe Limited on the date of acquisition was 800 million and accumulated depreciation of 320 million. During the year ended 31st October 2015, there was a revaluation gain of 80 million attributable to the holding company's property, plant, and equipment. Then it goes on to say, number four, other investments were sold for 240 million during the year. Number five, total purchase price of the 80% shareholding in Mwewe Limited was 360 million, which was paid by issuing 80 million worth of shares at par value, with the balance being paid in cash. Required. We are required to prepare group statement of cash flow using the indirect method for the year ended 31st of October 2015 in conformity with the requirements of IS number 7. So let's now go and do the analysis. I've said every time you're given a question on cash flow, find out from the balance sheet or from the statement of financial position, what is it that it can do to help you prepare this. So let's analyze all the items in the statement of financial position to see how they will help us to prepare our cash flow statement. Now, so we start with the first item from the balance sheet or from the statement of financial position. We must analyze all of them. The first one is property, plant. I have said a short while ago that you know for all other things, you know what you're looking for. But when it comes to property, plant, and equipment, there are three things the examiner may not give them to you. So from this question, we want to know, have we been given the cash paid to acquire new ones? Two, have we been given the division charge for the year? Because we need it as an uncashed item. Three, we need to know, have we been given the net book value of the disposed asset? Those are the three things you must find out, whether two of them are given or one of them is given, whatever it is. So let's go through this question and analyze whether we have been given the three. From note number one, we are just told, from note number one, we were told some machinery whose original cost was 680 million with a net book value of 360 was sold for 256 million. So now, from that note, I already know the net book value of the disposed asset. From there, I know the net book value. Then I need to know, have I been given the cash paid to acquire new ones? From this question, I can't remember anywhere where the question told us we paid this much to acquire new ones. No. So from this question, there is nowhere we are given the amount paid to acquire new property, plant, and equipment. I can't see any amount of deduction charge for the year from this question. So from this question, there are those two things that are not given. We don't know the cash paid to acquire new ones. We don't know. We also don't know the deduction charge for the year. And therefore, I hope you still remember a short while ago we have said, when you're not given any of those two things, how do you go about it? You prepare the two accounts. You have to separate. And that's what I want us to do now. So let us separate those two accounts, one called property, plant, and equipment, where we maintain it purely on the basis of cost. The other account we have said you prepare is the account called provision for depreciation, provision for depreciation, so that we now use one of them to determine the cash paid. We use the other account to determine the deduction charge for the year. So let's go to the balance sheet. Last year, we bring down the property, plant, and equipment book value last year. No, cost last year, because we are maintaining it at cost. The information for that is given to you under note number 1. The information for that is given to you under note number 1, where we were given the cost of the asset and the accumulated depreciation. And the cost last year, 2014, was given as 4,800. That was the cost last year. That was the cost last year. From the same note number 1, again, we were told, machinery with an original cost of 680 million was sold. Machinery with an original cost of 680 million was sold. We have said whenever an asset is disposed, you come and remove it and come and say a disposal. Again, don't forget we are maintaining this account at cost, so you must remove it at cost. So from note number 1, we are through for now with the items I require for the asset account. Let's go to note number 2. From note number 2, we are told we acquired a new subsidiary during the year. As a holding company, we acquired a new subsidiary. This subsidiary company that we acquired, we are told it came into the group. It came into the group with one asset by the name of property, plant, and equipment. In our previous class, we saw how to deal with acquiring and disposal of a subsidiary. You remember, we discussed how do you deal with the acquisition and disposal of a subsidiary. So because the subsidiary came into the group with a bunch of property, we bring it in. That is what we say. And for note number 2, we are given the book value. Those are the book values. But note number 3 told you the cost of the property, plant, and equipment of Wewe Limited. Wewe Limited was the subsidiary we acquired during the year. We are told their property, plant, and equipment was acquired, which was during the year, the cost of the property was 800 million. So now, because we are maintaining this account at cost price, we now bring it at cost. We now bring it at cost. We don't bring it at book value. Why? Because we are maintaining this account at cost. We are maintaining it at cost. That's what we are saying. Or if we were maintaining it at book value, you would have brought in the book value. That's all from note number 3. So I am through with note number 2. I am now on number 3. Number 3, we have used part of the first one. Number 3 also goes on to say, during the year, there was a revaluation gain of 80 million. During the year, there was a revaluation gain of 80 million. We know whenever there is a revaluation, we normally come and debit, and you come and see the revaluation, and the amount was 80 million. The amount was 80 million. From that note number 3, I am through. Note number 4 does not affect property. Number 5 does not affect. So we just carry down the balance now by the end of the year. And come and see the balance carried down. We go back to note number 1. That's where we were given the cost. Come the end of this year, the cost of the property, plant, and equipment is given as 5,800. Is given as 5,800. Now we want to get the balancing figure because we are through with the analysis of this account. Get the balancing figure to represent whatever is the cash paid to acquire new ones, whatever is the balancing figure to represent the cash paid to acquire new ones. So do that calculation, give me the balance to represent the cash paid to acquire new ones. How much is it that we paid to acquire new ones this year in cash? So we get the total of the other side, 680 plus 5,800. This other side is 4,800. there is 800, and there is the 80. I am getting a balancing figure of 800 million. Our figures are in millions, so it will be 800 million. So we are through with the amount of the cash paid to acquire new ones. Now, the other thing which was missing was the division charge for the year. So let's do the same. We fill in everything again, and there will be a balancing figure again. From note number 2, the accumulated division by the beginning of this year was given to you as 2330, not 2320. That was what we were given. Then we go through the question looking for anything concerning depreciation, and that is what we want to enter. From note number 1, we were told that the asset that was disposed were the same machinery that was sold at the original cost of 680, and a net book value of 360 was sold. So there was a disposal, which is this one. And don't forget to say, whenever an asset is disposed, you come and remove the accumulated depreciation of that asset. So if it had a cost of 680 million, that's what we are told by note number 1, and a net book value of 360 million, then it means if it had a cost of 680, and by the time of disposing it had a book value of the net book value of 360, what must have been the accumulated depreciation? The accumulated depreciation of that amount looks like 680 minus 360. It means by the time of disposing it, it had an accumulated depreciation of 320. It had an accumulated depreciation of 320. So from note number 1, I think I'm through. I brought down the accumulated by the beginning, then we have removed the depreciation of the asset sold. Note number 2, we acquired a new subsidiary. You remember this one, which came in. But we were told by note number 3, this subsidiary that we acquired came into the group with a machinery or a property, plant, and equipment, which had a cost of 800 million with an accumulated depreciation. The accumulated depreciation of this asset was 20 million. So if it had an accumulated depreciation of 320 million, the question is, that 320 now, do we debit in this account or do you credit? Don't forget, we acquired a subsidiary. It came into the group with a property costing 800 million. That property also had an accumulated depreciation of 320, meaning by coming in, it's making the division charge, the division for the group to be increasing. So you come and credit here and you say subsidiary acquired. That is 320. That is 320. That is from note number 3. From note number 4, I can't see anything else. Number 5, nothing. So the only thing remaining is for us to carry down the balance now. Is for us to carry down the balance by the end of the year. And according to the question, what are we carrying down? From this question, according to note number 1, we are carrying down an accumulated depreciation of 2720. Therefore, the balancing figure will represent the depreciation charge for the year, which normally goes to the profit and loss as a balancing figure. That's what we are getting. So let's get the balancing figure to represent the depreciation charge for the year. And according to this, 27, that is 320 on the debit side, plus 2720. On the other side, there is 2320, and there is 320. So I'm getting a depreciation charge for the year of 400. A depreciation charge for the year of 400. So we are through with the analysis of the account called property, plant, and equipment. So we have used it to get the cash paid to acquire new ones. That figure was not given to us. And we have also used it to get the depreciation charge for the year, Now we can go to the next item in the balance sheet. We have said you must analyze every item in the balance sheet. You must analyze every item in the balance sheet, seeing how it will help you to prepare your cash flow statement. And according to the balance sheet, our next item is called intangible asset. We have an asset called intangible asset. we need to know what happened to our intangible assets. What happened to our intangible assets, which we are being told the intangible assets include goodwill also. So let's feed in all the information in that account, and the balancing figure, we shall conclude what it is. We need to conclude what it is. So we got the balance sheet last year, and from the balance sheet last year, we pick the balance by the beginning, and according to the balance sheet last year, the intangible assets were given as 1560. Then we go through the question looking for anything concerning the intangible assets, concerning the intangible assets. Were we given anything from the additional? The answer is yes. That's what I want to talk about now. Get the point here, because we want to emphasize something that is hidden by the examiner. From note number two, we acquired a subsidiary. By the time we were acquiring that subsidiary company, their net assets were, according to that list, they amounted to 400 million. We were told we acquired 80% of the net of the shares. Of course, you know, when you buy 80% of the shares, you are buying 80% of the equity. And when you buy 80% of the equity, we say you are buying 80% of the net assets. So at the time of acquiring that subsidiary company, their net assets were given as 400 million. We bought 80% of the shares, which automatically means we also bought 80% of the equity. When you buy 80% of the equity, we normally say you're also buying 80% of the net assets. So the net assets you acquired amounted to 320 million. 320 million. But if you bought net assets amounting to 320 million, and note number 5 told you, the total purchase price of the 80% shareholding in Weber Limited was 360 million, which was paid in the following ways, whatever it is. To buy 80%, you paid 360 million. To pay 360 million, that is the amount paid or the purchase price. So if you will pay 360 million and you are buying net assets amounting to 320 million, the question is, why should I pay more to acquire less? Why should I pay more to acquire less? For you to pay 360 and you are buying net assets amounting to 320, it is obvious there must be something else you are buying. And what is it that you are buying? Listen to this now. These are the assets you acquired when you acquired that subsidiary company. Among these assets, the examiner, listen, among these assets, the examiner will never give you, among them, the examiner will never give you another asset you are buying. I hope you have already concluded what it is. Why? Because if you paid 360 and you are buying assets amounting to 320, then it means there must be something else you are buying worth 40 million. What do you think it is? If you are paying 360 and you are buying assets worth 320, you must have bought the goodwill of the firm or that goodwill of the subsidiary for 40 million. Don't forget, we were told the intangible assets was also including goodwill. So remember, every time you are acquiring a subsidiary company, in all your past papers, all the time you are given a question of acquiring a subsidiary company, among the assets you are acquiring, there will be another asset the examiner will never give it to you, and that asset is goodwill, which you will be required, you must calculate. You must calculate every time you are given a past paper question. That's important to remember, because I've never seen a question where the examiner has given you the goodwill at the time of acquiring that subsidiary. It's your responsibility to calculate. I will explain how we calculate. You find out at the time of acquiring this subsidiary company, what was their net assets. Then find out what was the percentage of the shares you acquired. Like in this question, you bought 80% shares. So if you bought 80% shares and the net assets were amounting to 400 million, then you bought 320 million worth of net assets. But to buy those net assets, you paid 360 million. To buy those net assets, you pay 360. Why should you pay more to acquire less? You must have bought something else, and that is what you are calling goodwill. So the examiner for this question wanted you to know, just like property came in when we acquired the subsidiary, just like property came in, there is another asset coming in by the name of goodwill. So you need to come and say your subsidiary acquired, and according to the question, it's coming to 40 million. Just to explain, we have said we are taking 360, we are minusing 80% of the 400. We are minusing 80% of the 400. This 400, don't forget, is what we are calling the net assets. That's how we are getting. We say by the time you're acquiring the subsidiary company, their net assets was 400 million. You bought 80%, that comes to 320, yet you are paying 360. So you are paying more to acquire less. You must have bought something else, and that is what we are calling goodwill. So it came into the group now. It also came in to the group. Then from there, I can't see any other information according to this question. I can't see any other information concerning intangible assets. So we just go and carry down the balance by the end of the year. And from the balance sheet come the end of this year, I can see we are carrying down intangible assets amounting to 1960. So we want to know what's the missing figure there in that account and what does it represent. Sometimes it could be there was impairment of intangible assets or amortization of intangible, or you could have bought some more intangible assets. So we need to find out what is the balancing figure in this account. Why? Because we are feeding everything that we need. What we're now missing is what we want to conclude. And what is missing looks to be on the debit side. What is missing looks to be on the debit side. And I hope you can conclude for yourself if what is missing is on this side. You know, and you should be able to know what it is. What do you think it is? I have said the two missing things, it could be on this side or this side. It could be impairment or amortization, or it could be that maybe we acquired new intangible assets. So from this illustration, if the difference is on this side, we must have acquired. So we come and say a cash paid. So we must have bought some more, because on the debit side, assets normally increase. So we must have bought some more intangible assets, and that is what we get as a balancing figure, So get the balancing figure. This looks like 16. 16, if you remove from here, you are left with about 360, if I'm correct. This is 1,600, subtract 19, looks like 360. So from this question, you must have bought some more intangible assets. You must have bought some more intangible assets amounting to 360, whichever the intangible assets, it could be patent, copyright, whatever, because they combined all of them as one amount. They combined all of them as one amount. So we are through with the analysis of the intangible assets. We go to the next one in the balance sheet again. Don't forget, we have said in the analysis, when you are given a question of cash flow, you must analyze every item. You must analyze every item in the balance sheet, seeing how it will help you to prepare your cash flow statement. So from there, we now go to the next one. And the next item in the balance sheet you can see is the account called investment in associate. Investment in associate. Of course, we reminded ourselves in our previous class, when you have an associate, I told you the relationship between the group and the associate when it comes to cash flows. I hope you remember, we say it is only the dividend received from the associate, the cash dividend. We said in the previous class, just to remind you very fast before we calculate it, we say when it comes to cash flows, the relationship between the group and its associate, when it comes to cash flows, you calculate what we call the cash dividend received from the associate. That one we said last time. So we need to calculate it, and I hope you remember, we said to calculate it, you prepare an account called investment in associate. We said you prepare an account called investment in associate. Where we say that again, you feed in all the information concerning the associate as much as the question will allow you, then there will be a balancing figure, and that balancing figure, we say, will represent the cash dividend received from the associate. So let's do that now. So from the balance sheet last year, our investment in associate is given as 400. I hope you remember we were picking What else from this question, from the question? You remember we were saying from the income statement or from the profit and loss, we were going back when I was trying to explain last time, we were going back and asking ourselves, do we have any profit share this year as a holding company? Yes, I own an associate. We own an associate. As a group, do we have our share of profit this year? The answer was yes. That's what we were trying to explain last time. So we want to go back to our group income statement and find out this year, as per this question, do we have any profit share? And according to this question, I can see, according to the income statement, this holding company or the group had a share of profit in associate, and according to the income statement, it was given as 160 million. Our profit share this year being 160, that makes my entitlement to grow. Don't forget, we said that last time. We said with any profit share, you increase your entitlement by debiting that amount, I can't see any other information concerning the associate, so we carry down the balance. We just carry down the balance by the end of this year, and according to the balance sheet this year, we are carrying down an amount of 520. I can see we are carrying down 520 from the balance sheet this year. So we need to determine the balancing figure, and we say the balancing figure normally will be on this side, and we said it represents the cash dividend received from the associate as a balancing figure. Of course, this is 560 subtract 520, that looks like exactly 40. That means this year as a group, from our associate, we received a cash dividend of 40 million, sorry. We received a dividend of 40 million. So that is our thing we talked about last time in detail when I was introducing the format of group cash flow statement. So you remember what we were saying about that associate. So from there, we go to the next item. Don't forget, we are trying to analyze every item in the balance sheet, seeing how it will help you. The other item, according to the balance sheet, is an item called in other investment. That one, we don't even need to open the account. You remember the question told us other investments were sold. The note number 4 told us other investments were sold for 240 million. So it's obvious, if they were sold, then we must have determined, we shall just determine whether there's a gain or loss on disposal. We don't need to open that account. We don't need to open that account. I can go to the next one, and the next item is among the current assets now, we have inventory. So let's open the account of the inventory so that we know whether there was an increase or decrease in stocks. So let's analyze the account of inventories. We want to know whether there was increase or decrease in stocks. So we bring down the balance of the stocks last year. From the balance sheet last year, what was the closing stock? And according to the balance sheet last year, the closing stock is given as 1016. Then we go through the question and ask ourselves again, was there anything affecting stocks? The answer is yes. Don't forget, we acquired a subsidiary company, and according to note number 2, that subsidiary that we acquired during the year again came into the group with its own bunch of stocks, and it came into the group with a bunch of stocks amounting to 400. We make that asset of the stocks to increase by 400. That's what we're saying. I can't see any other information, so the only thing remaining is for us to carry down the balance. Again, from the balance sheet this year, we are carrying down stocks amounting to 1,400, 1,400. Then the balancing figure again will either represent an increase or a decrease in stocks. I can see this side is 1416, this side is 14, so the difference is on this side, and because we are crediting this account, it's obvious it represents a decrease in stocks. So in our cash flow statement, we shall use a decrease in stocks amounting to 16 million. From there, I go to the next one, and the next one is trade receivables. I am analyzing the next item in the balance sheet, and the other one, they are calling it is trade receivables, trade receivables. And according to that, again, just like we have done this, now we bring down the balance. That one, there's no problem. And according to the balance sheet last year, our trade receivables were 2320. Again, we find out from the question, is there anything affecting trade receivables? The answer is yes. From note number 2, we acquired a subsidiary. It came into the group with its own bunch of trade receivables. We come and debit. And according to the note number 2, we brought in stocks or data, amounting to 160. Then we carry down the balance by the end of the year. We carry down the balance by the end of the year. And according to the balance sheet this year, we are carrying down debtors amounting to 2920, 2920. Then we get the balancing figure again. We get the balancing figure again to represent an increase or a decrease in debtors. This looks like we must calculate. The other side is 2920. This other side is 2320 and 160. I'm getting a difference of 440, and it's on the debit side, and that looks like obviously representing an increase in debtors, an increase in debtors. So I'm through with the debtors account. Now we go to the next one. After debtors in the balance sheet, I can see, you see, that is what they are calling financial asset at fair value. Financial asset at fair value. Obvious. I do hope you know how to use it when it comes to cash flow statements. Whenever you are given financial asset at fair value and you are given among the current assets, how do you use them when it comes to cash flows? Of course, you must have done this before in your cash flows of section 3. You must have done them in the section 1 cash flows. Whenever you are given a financial asset at fair value and it is given among the current assets, I am not talking of among the current fixed assets, no. There are some questions that give you financial assets at fair value, but still under fixed assets. But this one is not giving us among the fixed assets, it's giving us among the current assets. So when you are given a financial asset at fair value among the current assets, I am hoping you still remember how you used to use it as far as cash flow is concerned. It is obvious, you remember that you had to use it as part of cash and cash equivalent. When you are analyzing the cash and cash equivalent in your cash flow statement, you use it as one of them. That's what I hope you still remember. But from your previous classes, whenever you are given a question on cash flow and you have a financial asset at fair value among the current assets, then you analyze it when you are analyzing the cash and cash equivalent in your cash flow statement. So we shall leave that amount for now. We shall leave it for now. We shall use it when we are preparing cash flow statement. When we come to that part of cash and cash equivalent, remember, we shall bring it there also. So now, for now, we leave it. We don't need to open the account for it. I don't need to ask you, what if this financial asset at fair value was given among the fixed assets? If it was given among the fixed asset, then you analyze it like any other fixed asset. The way we have analyzed the property, plant, and equipment, and the way you analyze this other intangible asset, you analyze it. It's an investment. And when you are given an investment, when you are given financial asset at fair value among the fixed asset, it is obvious it's an investment. And therefore, we are saying this investment being a fixed asset, a long-term asset, you use it in your cash flow, among the investing activities, But when you are given an investment, which is the same, a financial asset is still an investment. When you are given an investment among the current assets, that's the point I'm trying to emphasize. Whenever you're given an investment by whatever name, ours, they were calling it financial asset, but some questions just call it investment at fair value among the current asset. The point you need to know there is when you are given investment among the current assets in your balance sheet, then analyze that investment together with other cash and cash equivalent. That's what we are saying, that any investment by whatever name among the current assets in your balance sheet, then for purpose of cash flow, use it as part of cash and cash equivalent. That's one. If you are given an investment among the fixed assets in your balance sheet, then in your cash flow, analyze it among the investing activity items. So we shall leave that one for now. We shall analyze it together with the cash. From there, I go to the next item, and after financial assets, we are given cash. I've already talked about it. That one we don't analyze it. We shall analyze it together with the other cash and cash equivalent when it comes to cash flows. We now move on to the next item. Don't forget we are trying to analyze every item in the balance sheet so that we see how it will help us to prepare our cash flow statement. And the next item, according to the balance sheet, is ordinary share capital. So we need to know whether we could have issued more shares or we never issued more shares this year. I do hope you still remember, every time you had to analyze the account of share capital, you are not analyzing it alone. You are not analyzing it alone. You had to analyze it together with an account of share premium. So every time you had to analyze share capital, you had to analyze it together with the share premium account. Why? Because the two normally go together. When shares are issued, they are normally issued at a premium, and therefore when you're analyzing the account of share capital, you analyze it together with the account of share premium because the two normally go together. So let's bring down the two balances by the beginning of the year. From the balance sheet last year, bring down the balance of the ordinary share capital, bring down the balance of the share premium. According to the balance sheet last year, our share capital was given as 1280. Our share capital was given as 1280. Last year, our share premium was given as 1120. Then we go through the question looking for whether there was anything in the additional information that affects these two accounts. And from the question, note number 1, there is nothing. Number 2, there is nothing. Number 3, there is nothing. Number 4, they are saying nothing there. Number 5, they are saying the total purchase price of the acquisition. The note number 5 is saying the total purchase price of 80% shareholding in Huawei Limited was 360 million, which was paid, that's where we are, which was paid by issuing shares worth 80 million at par with the balance being in cash. So we are saying to acquire that subsidiary, don't forget we are to pay them 360. Part of this purchase consideration, we settled it by issuing shares. We settled as a company, we settled part of the purchase consideration by issuing shares. So when we issued shares as a result of acquiring the subsidiary company, that automatically means our share capital went up. So you will now come and increase your share capital by that 80 million. We issued shares to buy that subsidiary company, and according to that note, that's what we do. From the additional, we are through. Now we can carry down the balance by the end of the year. Now we can carry down the balance by the end of the year. One balance in terms of ordinary, the other one in terms of premium, the other one in terms of share premium. So from the balance sheet this year, now we can pick the two balance carry down. For the share capital, I'm given 1680, while for the share premium, I'm given 1200. So let's see whether there's a balancing figure in this account, and if there is, that will represent the cash we receive from issue of new shares. So on the debit side, I can see 1680 plus 1200. On the credit side, I can see 1280, 1120, and 80. And it looks like there's a difference, and the difference is on this side. We must have issued some more shares to the members of the public in cash. So cash received. From issue of new shares by cash, we must have received. So we are now saying this account has helped us to determine the cash received from issue of new shares. We issued shares as a payment, that one there is no cash coming in, but to those which we issued by cash, we must have issued shares worth 400 million by cash. So that account has helped us to determine the cash received from issue of new shares. From there, we normally go to the next item, and the next one is the revaluation reserve. So let's analyze it. We want to see whether it has agreed. Normally, you know, revaluation reserve does not affect cash flows, but it is normally required to reconcile that account. It's normally required that you should reconcile that account. Though no cash is involved in this revaluation account, sometimes it may be used to affect another account somewhere. But for now, let's see what is affected here. We bring down the balance by the beginning. And according to the balance sheet last year, the revaluation reserve was given as 728. Then note number three, sorry, you remember, note number three, you remember we have just used it a short while ago. We were told that there was a revaluation gain. We revalued our assets. We debited asset, we credit now this revaluation. We debit the asset, we credit revaluation, and there was a revaluation gain of 80 million. Then we carry down the balance because I can't see any other information. We carry down the balance. And according to the balance sheet this year, we are carrying down a revaluation reserve of 800 million. We are carrying down a revaluation reserve of 800 million. This side, we get a 8, sorry, 0 and 8. This should be 808. There's a difference of 8 million. What do you think it represents? From the revaluation reserve, there's a balancing figure. I have said, though it does not affect cash flows, but I've said sometimes the missing figure here could be utilized in analyzing another account somewhere. So now that there is this balancing figure of 8 million, what do you think? It must be, remember, the revaluation is not increasing. If it was increasing, we normally credit. The revaluation is reducing. So whenever there's a decrease in revaluation, it means there must have been a transfer from this account because we are debiting the account by 8 million. It must be there was a transfer from the revaluation account or revaluation reserve, but the question is to where? Whenever there's a decrease in revaluation, what would have been the cost of that revaluation? Whenever there's a decrease in revaluation, then it means these assets that were revalued. The point is this, that asset that was revalued, every time an asset is revalued, don't forget, I hope you still remember, whenever assets are revalued, normally depreciation is normally calculated. From the year the assets were revalued, from there onward, we normally calculate depreciation on the revalued amount. And there is an accounting standard which says whenever an asset is revalued, you are also required to affect the revaluation reserve for that asset. As the asset is losing value through depreciation, don't forget, we have said if an asset is revalued, we normally depreciate it from now onward on its revalued amount. And if you are depreciating it on the revalued amount, then it means there is an extra charge you are charging this year just because of the revaluation gain. So now that there was this revaluation gain, it means the charge for the current year also included part of this. So there is an accounting standard for property plans which says when an asset is revalued, that's IS number 16, which requires that if an asset is revalued, the policy could be of the company, it can choose that if they are revaluing the asset, as they are consuming the asset through revaluation, as they are consuming the asset through depreciation, then there should also be a revaluation decrease in respect of that revaluation. And that revaluation decrease, which is this one, normally goes to the profit and loss. It is an amount that goes to the profit and loss as an appropriation. From the appropriations of the profit, meaning you take it to the P&L as part of the retained profit, meaning you charge, among your retained profit, you charge an amount of 8 million there. That's how we treated that amount. So this 8 million must have gone to the profit and loss, must have gone to the profit and loss. That is from your knowledge of property, plant, and equipment, that when an asset is revalued, that asset should be depreciated on its revalued amount. As the asset is losing value, you also consume the revaluation. Here was a gain of 8. Now we consume the revaluation by charging part of the revaluation gain to the profit and loss because you are revaluing the asset, and because of revaluing the asset and charging depreciation on the revalued amount, that charge you are putting in the income statement, part of that charge is because of the revaluation. So you also charge revaluation decrease in respect to that. So there are those two policies. There are some companies that may choose not to depreciate, not to charge revaluation decrease. But if they choose, like this one, we are saying you now come and debit revaluation, you must have credited retained earnings. You must have credited retained earnings. So that's all for the revaluation. The next item as per the balance sheet, of course, is the retained profit. We normally don't analyze the retained profit because we use it in the cash flow statement. We normally use it in the cash flow statement. From there, we go to the next one, and the next one is non-controlling interest. We need to analyze the account called non-controlling interest. That one I hope you still remember very well when we were discussing it in our previous class, how to use it for cash flow. What did we say? Of course, non-controlling interests are those shareholders who have no control in the company. And we say the relationship between the group and its non-controlling shareholders, the relationship between the group and those shareholders, when it comes to cash flows, we say you determine an amount called what? We say you determine an amount called cash dividend paid to the non-controlling interest. So let's determine the dividends. So we want to use this account. We want to use this account to determine the dividends paid to the non-controlling shareholders, That's what we said in our previous class, and that's what we want to apply now. So let's go bring down the liability by end of last year. So from the balance sheet last year, we owe the non-controlling shareholders, we owe them an amount of 240. Then we go through the question, finding out, is there anything affecting them? And the answer is yes. From the income statement of the group, they were entitled to a profit share. And according to the income statement, we were told their profit share is 120. And so because they are entitled to a profit share, we increase what we owe to them, that is 120 from the income statement. That's what we were given. Then we go through the additional information, looking for anything else affecting the non-controlling shareholders. Is there anything else? The answer is yes. There is something else. From which note? From note number 2. That note number 2 told us when we acquired this subsidiary, that subsidiary came in with a total net assets amounting to 400 million. Now, not forgetting, we acquired only 80% shares, and so we acquired 80% net assets. But from your consolidation topic that every time you are consolidating, you normally consolidate the subsidiary as though you control 100%. But we don't own 100, we own 80%. So it means if I own 80% and I took everything of the net assets, like as if I control 100, but I don't own 100%, it means 20% of these net assets. It means 20% of these net assets, they are not ours. They belong to the non-controlling shareholders. And therefore, the point is this. Because they own 20% shares, they also own 20% of the net assets of the subsidiary that came into the group. And because they are entitled to 20% of the net assets, therefore, as a group, we owe them another 20% of the net assets. So we need to come and say, as a result of acquiring that subsidiary company, our liability to the non-controlling shareholders increased by an amount of what? It will be 20% of the 400,000, 20% of 400 million, and that comes to 80 million. So that's all for the analysis of the from the additional. Now we carry down the balance. And from the question, what are we owing the minority shareholders or the non-controlling? From the balance sheet, by end of this year, we owe them 400 million. According to the balance sheet, we owe them 400 million. And therefore, we now use the balancing figure to represent the dividends paid to the non-controlling shareholders. And we come and say your cash dividends paid. We say the balancing figure here represents the cash dividends paid to the minority shareholders as a balancing figure. And therefore, we come and say the other side is 240 plus 120 plus 18 and this side is 400. So I'm getting a balancing figure of 40. So it means this year we paid the non-controlling shareholders, we paid them a dividend of 40 million. We paid them a dividend of 40 million. Then we go to the next item. Don't forget, we said we are analyzing one item after the other in the balance sheet. We are analyzing one item after the other in the balance sheet. And the next one in the balance sheet is an item called debentures. So let's analyze. We need to know, could we have issued some debentures during the year, or did we repay our debentures? That's what we want to know as a group. Did we repay our debentures, or we could have issued new debentures? And from the question last year, our debentures were given as 400 million. We bring them down. We go through the additional information, looking for any other information that affects debentures. Was there anything? Yes. From note number 2, we were told the subsidiary that we acquired again came into the group with its own bunch of debentures amounting to 320 million. If it came into the group with a bunch of debentures, it means our liability to the debenture holders went up. And so we come and credit. And the debentures that came in amounted to 320 according to note number 2 from the subsidiary that we acquired. I can't see any other information from the additional, so the only thing remaining is to carry down the balance by the end of the year. And from the balance sheet this year, we are carrying down debentures amounting to 1360. So let's get the balancing figure now. Either we must have repaid part of our debentures, or we must have issued some more by way of cash. That's what we want to analyze. So let's get the balancing figure in this account. And this side is 1360, the other side is 400, 320, and it looks like the difference is on this side. What do you think it is? Did we issue more debentures? We repaid our debentures? It's obvious for debentures to go up, because this is the credit side, we must have issued some more debentures. So we come and say a cash received. We must have issued some more debentures. Therefore, we come and say a cash received, and that is the balancing figure of 640. Then from there, we go to the next item, and according to the balance sheet, we are analyzing the next one, and the next one, according to the balance sheet, is trade payables. Why do we need to analyze the account of trade payables? We need to know whether there was an increase or decrease in creditors. That one is simple. So we come and see a trade payables. And the trade payables last year was 1392. We bring it down, 1392. Then from note number 2, we acquired a new subsidiary again, and it came into the group with its own bunch of creditors. We come and see a subsidiary acquired. And this subsidiary that we acquired came into the group with a bunch of 200 million. Then we carry down, because I can't see any other information, we carry down the balance by the end of the year. And according to the balance sheet this year, we are carrying down trade payables of 1616. Then we get the balancing figure again. It will either represent an increase or a decrease in creditors. It will represent an increase or decrease in creditors. The debit side looks to be more, so we come and say 16 minus 1392 minus 200. I'm getting a difference of 24. What do you think it is? An increase or a decrease? It is obvious it's an increase. Why? Because creditors are always a credit balance. So if the difference is on the credit side, that represents an increase in creditors. We go to the next one. And after there, we have accrued expenses. I can see last year the accrued expenses were the same as those this year. So we don't need to open that account. We don't need to analyze that account. Bank overdraft, don't forget. Bank overdraft, you know, from your cash flow knowledge, we normally use it as part of cash and cash equivalent. Then I can see the last one there is taxation. Our last account that we want to analyze is taxation. So let's open the account of taxation. Why do we need to analyze that account? We need to know how much was the tax paid during the year. So we need to analyze the account of taxation. Go to the balance sheet last year, bring down the liability by the end of last year. And from the balance sheet last year, our tax liability was 880. Then you go to the P&L or to the profit and loss, see what was the charge for the year for taxes. Go to the income statement, what was the charge for the year for taxes. And from the income statement, last year, this year, sorry, from the income statement, the tax charge this year was given as 1120. You know it's normally debited in the profit and loss, so we come and credit, that is 1120. Then we go through the additional information, seeing whether there's anything affecting taxes. And from the question, yes, there is. That subsidiary that we acquired came again into the group with another tax liability of 40. So do you think we debit or we credit? It came into the group with a tax liability of 40. Do you think we should debit or credit? Obviously, we should credit. And come as a subsidiary acquired. It came into the group with a tax liability of 40. It came into the group with a tax liability of 40. I think I'm through. Now we can carry down the balance by end of the year. Balance carry down. And according to the balance sheet this year, we are carrying down a tax liability of 960. So let's get the balancing figure now. Let's get the balancing figure now. And that will represent how much we paid for taxes this year. We come and say a cash paid, and that will give us the balancing figure. So if I add this, the credit side, that is 880 plus 1120 plus 40. This other side, there is 960. So it means we paid a total of 1080. Cash paid, the balancing figure is 1080. So I'm through with the analysis of the items in the balance sheet. Now, before we now prepare the actual cash flow, let me emphasize one thing which you must have done in your previous class and which I also told you last time when we were discussing. Among the financing activities in our cash flows, among the financing activity items in our cash flows, you remember we said for group cash flow, we shall have something called dividends paid. We said last time, in the cash flow for group companies, there are two categories of dividends. There is the dividend you as a group, you pay to your own members, dividends paid to group members, whatever it is. And there's a dividend, we say, which you normally pay to the non-controlling interest, non-controlling interest or non-controlling shareholders. From this question, we have calculated the dividends paid to the non-controlling interest. I remember it was here, and we got that one as 40. That one we know. But according to this question, the examiner has not given you, how much was the dividend paid to the other group members. Even from section 3 questions, when you are doing financial reporting, you were given some questions again where the examiner never used to give you the dividends paid to group members. How are you to calculate them? That's what I want you to remember. How are you to calculate them? That means we want to apply the same knowledge you used in section 3 for financial reporting. Now we want to ask ourselves, whenever you are not given the amount of the dividends paid to group members, how are you calculating that amount? How are you calculating that amount? To calculate the dividends paid to group members, of course, you had to work backwards by completing the income statement, Normally, whenever they give you a question on cash flow, the examiner will normally not complete the profit and loss. He will not complete it. Meaning, he will normally leave the appropriation part of the income statement. Now that you are not given the complete income statement, for you to get the dividends that we as a group will pay to our own shareholders, normally you are required to complete that income statement. And that's what we want to do. Once we complete it, there will be a balancing figure. There will be a balancing figure whereby now we know we shall now use it as the dividends paid. To complete the income statement, you know we normally take profit after tax, just to remind you. Then we normally say part of this does not belong to us, it belongs to the non-controlling shareholders for group income. You know, whatever is the income, whatever is the profit share of the non-controlling interest, we normally remove it. Then we normally get the profit attributable to the ordinary shareholders of the group. I hope you still remember that. Then we normally come and say you minus the dividends paid, minus any dividends, whatever it is. That one I hope you remember. Then you normally get what we call retained profit for the year, retained profit for the year. Then you remember we normally add whatever is the retained profit brought down, whatever is the retained profit brought down, whatever it is. Then you normally get what we call retained profit carried down. I hope you still remember how you used to complete your income statement. So for this question, we know the profit after tax. We know the share of the minority or the non-controlling interest. We know from the balance sheet what we are carrying down as the retained profit carried down. We know from the balance sheet of the previous year or the statement of financial position, we know from the balance sheet last year what was the retained profit carried down. So if we know those things, is it possible we can use them now to get the dividend? The answer is yes. Why? Because if I know what was the retained profit carried down and I know what was the retained profit brought down, it is possible to know what was the retained profit for the year. So if I know the profit attributable to the ordinary shareholders and I know what was the retained profit for the year, then it's possible to get what we are calling the dividends paid during the year. And that's how we want to calculate it. That's how we want to calculate it. So I've reminded you how we used to calculate. I've reminded you how we used to calculate the dividends for the group members, for the dividends for the group members. So let's use it now. So we want to determine dividends paid to group members. That's what we want to calculate now. Dividends paid to group members. So let's work backwards. How? By taking the profit after tax, and according to the income statement, the profit after tax was given as 1440. Then I say you less what belongs to the non-controlling shareholders or non-controlling interest. They had a profit share there. The non-controlling interests were entitled to 120. So it means as a group, we are now remaining with our profit attributable of 320. Now, one thing I reminded you, I said when we were analyzing the account code revaluation, I told you there was a balancing, or we saw there was a balancing figure on the debit side, and that balancing figure, we got it as 8 million. You remember what it was? We said that whenever an asset is revalued, it is required that a company, when they revalue the asset, they should provide depreciation on the revalued amount, and the policy is to that whenever they are revaluing on the revalued amount, they should also provide for a devaluation decrease on that asset. And so we saw that because the company used that policy, we said this 8 million was to go to the profit and loss. In other words, we said you charge it to the retained profit. You charge it to the retained profit. So now we can see if this was the profit that the group members are supposed to appropriate, and we debited revaluation reserve by 8 million, then it means before you come and minus dividends and get the retained profit, this question wanted you to remember that there was a revaluation reserve that affected part of the retained profit, and having debited revaluation reserve, you must credit P&L. So we come and say a revaluation reserve, or we can say a transfer from revaluation. We can put it that way. Transfer. Remember, it was a transfer from revaluation. We debited revaluation reserve account. That automatically meant there was a transfer from there of 8 million, meaning we debited revaluation, we credit P&L. And when you credit P&L, are you adding or subtracting, automatically you add because you are increasing. So this will come to 1328. That will come to 1328. So for dividend calculation, that was the only thing that the examiner wanted to hide. Most other questions don't have it, don't have that revaluation reserve. Otherwise, if there is no revaluation reserve, do like I showed initially. But for this question, they wanted you to remember there was that revaluation. Then we come and say, unless dividends paid, which we are saying we don't know. That's what we are trying to calculate as a balancing figure for now. Once you minus that, you normally get what we call retained profit for the year. You normally get what we call retained profit for the year, retained profit for the year, which for now we don't know. Then you normally add what we call retained profit brought down. You normally add what we call retained profit brought down. And of course, the retained profit brought down, where do we get it? We get it from the balance sheet last year. We get it from the balance sheet last year. And according to the balance sheet last year, our retained profit last year was given as 960. Then we get what we call retained profit carried down. Retained profit carried down, which from the balance sheet last year, this year, sorry, it's given as 1400. Now we can work backwards. And that means our retained profit for the year should be something like 0. I am adding 6. That must be 3. That must be 2. No, we are subtracting, sorry, not adding. We are subtracting, not adding. We are going backwards. So this we subtract, that must be 0, that must be 4, that is 13, 4 for 40. Then we come and say, if the profit that was supposed to be retained was 1320, but we paid a dividend of whatever the amount and we retained this, what must have been the dividends paid? What must have been the dividends paid? So let's calculate it. This will be 1328 minus 440. We must have paid a dividend of 8,888,000,000. That's what we must have paid. So I'm through now with our workings. Now we can prepare our cash flow statements now. So let's prepare our group cash flow statements now. Now we have the majority of the information we need, so we shall move a bit fast now because we have done all the necessary workings. So let's prepare the group statement of cash flows, where you remember we said you start with cash flow from operating activities. Cash flow from operating activities. You remember we said you start with the net profit before tax. And if you remember, we say you pick it from the income statement, and our profit before tax was 2560. Then we said you adjust it with all non-cash items. I hope you still remember them. We said you start just with all non-cash items, one of them being depreciation charge for the year. That is an obvious item which is normally found in all questions. Depreciation charge for the year is found. And for this question, we were not given the depreciation charge. So go to where we calculated. What did we get as the depreciation charge? I remember we got a depreciation charge of 400 million. That's what we got. Then we go now looking for any other non-cash item. We look for any other non-cash item according to this question. When we were discussing the format in the previous class, we said another non-cash item is obviously the finance cost. What the question is charging in the income statement is normally a charge, not what necessarily they pay, but it's obviously a charge. You remember our discussion in the previous class. So whatever is the finance cost in the income statement, normally that is a non-cash item, and the amount is 600. That's what we charge. So let's go looking for more non-cash items. I hope you have got some more. So let's go through maybe the additional information looking for other non-cash item. From note number 1, we were told there was a disposal of an asset. Was it giving us a gain or loss? By the time we were disposing that asset, according to that note, the book value we were told was 360 million, but it was sold for 256 million. So if an asset was sold at 256, but by the time they were selling it at a book value of 360, then there was a loss on disposal. Loss on disposal of machinery. Loss on disposal of machinery. We are comparing the cash we received of 256 million minus the book value of 360 million. So somebody with a calculator, give us the amount. Give us the amount of the loss on disposal of machinery. And that is 360 subtract 256. I'm getting a loss of 104. That's what we are getting. Then from note number 1, I think I've used depreciation. From note number 2, there is nothing there. Number 3, there was that information of the acquisition of the land. That's okay. Number 4, yes, you remember, we were told from note number 4, we were told other investments were sold for 240 million. For an investment to be sold for 240, there must have either been a gain or loss on disposal. And I can see from the balance sheet last year, the book value of the investment was 200 million. If we sold it for 240 million, we must have made a gain. So we come and see a gain on sale of investment, gain on sale of investment, gain on sale of investment. We sold it for 240 million at a time when it had a book value of 200 million. So we made a gain of 40 million. Of course, you know it made your profit more, so you deduct. You know that you normally deduct. Now give me other non-cash items. Give me other non-cash items. Okay. From your income statement, we need to know, do we have other non-cash items? And the answer is yes. From the income statement, I can see there was that profit share in associate. We discussed that in detail in our previous class. We say when you have an associate as a holding company, when you have an associate, you normally take your share of their profit from their income statement, you normally take your share of their profit. But that's not what you received in cash. What you received in cash, we say, is the dividend. But when you computed your profit share, you took your percentage on their profit after tax. That is also another non-cash item. So we come and again say profit share from associate, profit share from associate. Of course, it's not something we received. We just accounted for a share from the associate of that amount, profit share from associate. And according to the income statement for the group, we as a group, we have received or we had accounted for our profit share of 160 million. It made our profit more than it should be, yet we never received 160. What we received was the dividend, which we had computed. You remember we have computed it, which we shall use in the cash flow among the investing. From the same income statement, I can see, there is what we are calling investment income. This is something you should know, and I hope you still remember even from your section 3, financial reporting. Investment income is not an operating activity item. I hope you know that investment income is not an operating activity item. We are trying to determine the cash flows from operating. Yet, when they were determining this profit, within that profit, there is the investment income. You know where investment income belongs whenever you are preparing cash flow. Of course, you know investment income is always an investing activity. And so, if we are determining cash dividend, we are determining cash flow from operating, and yet there was a cash dividend, there was a profit share from, there was that investment income we need to transfer. So let's remove it from the operating and take it to, we remove it from the operating and take it to investing activity. So any investment income, we remove it. We are not removing it because it's an cash item. We are removing it because it is not an operating, but it is an investing. So we are transferring it to where it belongs. And according to the question, the investment income was 200 million. We remove it. I think we are through with the analysis of the non-cash item and all that we need to know there. So we now get the net. And that net, you remember, is what we were calling cash flow. Is what we were calling cash flow before working capital changes. Cash flow before working capital changes. So let's get the net. So we take that 2560 plus the 400 plus the 600 plus the 104 minus the 14 minus the 160 minus the 200. What are you getting? I'm getting 3264. Then now we can go to the working capital items. We did the analysis very fast. So we just go to where we analyze the accounts of the working capital. What did we get as the position of stocks? Inventories gave us an increase or a decrease. Find out from the workings that we did. We got a decrease in inventories, and the amount was 16. So whenever there's a decrease in stocks, is that an inflow or an outflow? Obviously, it is an outflow. No, it is for stocks to go down, for stocks to go down, you must have sold. It is when there is an increase, that's when it's an outflow. But now we sold, for stocks to go down, you must have sold. That's an increase or an inflow. That's an inflow. That's all for inventory. From there, we analyze the trade receivables. What did we get? From the trade receivables account, when we analyzed it, we got an increase. We got an increase, I think so, in trade receivables. Confirm my workings. We got an increase in trade receivables of how much? From our workings, we got an increase of 440. An increase of 440, that is an outflow. From the current assets, I think we are through. From the current liabilities, we go to trade payables. What was the position of the trade payables? There was an increase again. We had an increase in trade payables. Increase in trade payables. That is a working we have done. And according to our workings, how much did we get? We got 24. That is an inflow. I can see there are accrued expenses which had no change. There was no increase or decrease in accrued expenses. That's all. We get the net. So we now get the net because I'm through with the analysis of the working capital. So that is 3264 plus 16 minus 440 plus 24. I'm getting 2864. From there, we said you go to what next? We said you now come and say tax paid. Tax paid. So go to the account we prepared. We must have done the workings for the amount paid for taxes. What did we get? For tax paid, we got an amount of 1080. Then we get the net, and that comes to what? Comes to 1784. That is what we are calling net cash inflow. Net cash inflow from operating activities. Net cash inflow from operating activities. So we are through with the first category. We are through with the first categories of cash flows. Now we want to go to the second category of cash flows. And that is cash flow from investing activities. Cash flow from investing activities. Cash flow from investing activities. So let's go through the question and identify which are these cash flows from investing activities. There was some, of course, from note number 1, you remember we sold an equipment, we sold a machinery. So we come and see a sale of machinery. You remember here, when we computed the gain on sale of machinery, we sold the machinery for 256 million. So we come and see a sale of machinery, that is an inflow, 256 million. Another investing activity, we can see there was a sale of investment. There was a sale of an investment, and that was a long-term investment, don't forget. So we come and say, because it was a long-term investment, come and say a sale of investment, sale of investment. And we were told we sold it for 240 million. That is an inflow. Another thing we have just said a short while ago is that when you have an associate, I hope you remember, we said the relationship between the group and its associate, when it comes to cash flows, we said you look for cash dividends received from the associate. And we say the cash dividend received from the associate should be considered as an investing activities. Cash dividend received from associate. So go to where we did that working, where we prepared the account of investment in associate, where we prepared the account of investment in associate. What did we get as the balance? We got a balancing figure of 14 million. We received a dividend from the associate of 14 million. Then from there, we now come to investment income. Don't forget, we said investment income is an investing activity. So we come and bring it to where it belongs, investment income. Investment income, and the amount was 200 million. So those ones, I'm just picking them from the cash flow that we have just done. Now we can go through the additional information and pick the others. You remember we prepared the account of property, plant, and equipment, and from that account, we determined there was a purchase of plant and equipment. So go to where we analyzed that account, go to where we analyzed the account, how much did we get at the balancing figure to represent the cash paid to acquire new property, plant? We got an amount of 800 million. Of course, we are purchasing, that's an outflow. That is what we did when we were analyzing that account. Any other investing? Yes. We acquired a subsidiary company. I hope you still remember. We acquired a subsidiary company and we purchased the subsidiary company, and the purchase price was 360. This is also something I mentioned last time when we were doing the analysis of cash flow format. I discussed this. The purchase price or the purchase consideration was 360 million. We were told 80 million was paid in what? From this question, there was that last note which told us 80 million was paid in cash, no, in terms of shares. Then the question told us the balance was paid in cash. So if the purchase consideration to acquire the subsidiary, the cost was 360 million, of which we paid 80 million in terms of shares. How much is it that we as a holding company, we paid in cash? Looks like 240. So if we paid 240 million cash to acquire a subsidiary company, 280, not 240, sorry, 280 million to acquire that subsidiary. So we need to come and say here, purchase of subsidiary. Now, we say this, if you paid 280 million cash, we say you do not, that was very important, you do not bring this to 80 million in the cash flow statement. As much as it's true you paid 280 million, we say you don't bring that amount there. We say to get the amount you take the cash flow statement, we say you get the net aggregate, How are we getting that net aggregate? We say you take what came in, you remember, you minus what went out. As much as it's true we paid 280, that's what we say it goes out. We discussed this in our previous class. But we say among the assets you are acquiring, when you acquired that subsidiary company, from note number 2, among the assets you acquired, there must be an asset of cash or cash equivalent there. And according to this question, from note number 2, we saw that among the cash and cash equivalent coming in, when we acquired this subsidiary company, there was a bank overdraft. There was a bank OD amounting to 80 million. So to buy this subsidiary company, yes, we paid them 280 million, but they gave us an overdraft of 80 million. So we said you take what came in, you minus what went out. What came in is an overdraft of 80 million. I hope you still remember that in our previous class. What came in is 80 million, but what we paid out is 280 million. So if I paid you 280, and among the assets you are giving me an overdraft of 80 million, then what is the net aggregate cash outflow? We say take what came in, which is that negative 80, because an overdraft is a negative, it's negative 80. We minus what went out, which is this 280. So in total, we paid how much? In total, we paid 360 cash. We paid 316 cash. That is an outflow. That is an outflow. So I think we are now through. With the investing activity items, unless there is something else we are remaining with. Find out whether there's something else we are left with. Oh, yes, I remember there was that account we analyzed of the intangible. Yes, we analyzed the account of the intangible, and so there was that purchase of intangible asset. There was that purchase of intangible assets. We were almost forgetting intangible assets. Go to where we analyzed the account of the intangible. What did we get? When we analyzed the account of the intangible assets, we bought some more intangible assets amounting to 360. Again, 360. I think now I'm through. I can't see anything else. We get the net. We get the net amount. So this comes to 256 plus 240 plus 40 plus 200 minus 800 minus 360 minus another 360. I'm getting a negative 784 negative. If it's a negative, you know, we normally call it net cash outflow. You normally call it net cash outflow from investing activities. Net cash outflow from investing activities. So that's all for the second class. We now go to the last category of cash flows, and that's what we call cash flow from financing activities. I don't have enough space. Let me come here. We want to come now to cash flow from financing activities. Cash flow from financing activities. These ones are obvious. Some of them are normally obvious, like there was issue of shares, you remember? You come and see the issue of shares. How much did we receive from the issue of shares? We analyzed the account of share capital and we got an amount of 400. What else? You remember we analyzed the debenture, go to where we analyzed that debenture, and we saw there was an issue of debenture. Issue of debentures, you remember? So go pick that amount. What did we get? From our workings, we got some issue of debentures amounting to 640. The other financing activity item we analyzed was which one? Those are the two major finances in terms of debentures and the share capital. Now we can pay the financials their returns. We come and pay the shareholders their dividends. So we come and see their dividends paid. Don't forget, we have said there are two categories of dividends. There are dividends paid to group members, and there's dividends paid to the non-controlling interest. So go to where we did that working. We got an amount of dividends paid to group members of 888, you remember, while for dividends paid to the non-controlling shareholders, we paid them 40, I remember. From there, we come to the last item, and the last one is what we call interest paid. I want to explain that one. When we were doing our cash flow statement among the financing activity, operating activities, we saw there was that finance cost. And the finance cost, according to the income statement, the finance cost was given as 600. From this question, the finance cost charge was 600. There was no interest that was owing anywhere. There was no interest accruing anywhere in this question. So it means the examiner wanted you to know if the interest charged in the income statement was 600, which we considered as an uncashed item, but at the same time, there was no interest owing, there was no interest accruing by the end of the year, it means what you charge in the income statement must have been the same amount we paid this year. There are some questions that give you in the balance sheet or in the statement of financial position some interest owing. If they give you interest owing by the beginning or by the end of the year, you must calculate the amount you paid during the year, just like we did for taxes, you must calculate. But for this question, there was no accrued interest. So we are saying, because there was no accrued interest, if we were to prepare the account, I would have come and said, dear interest, bring down the balance, which is owing 0. In our question, it was 0. I would have come and said, dear, to the profit and loss, pick this charge for the year 600. I would have come and said, dear, balance carried down for the accrued interest by the end of the year, which in our case is 0, which means in the balancing figure, just like we did for tax pay, the balancing figure will represent the amount paid for interest, which in the same case is the same amount we have as the charge. So now that there was no accrued interest by the beginning, there was no accrued interest by the end of the year, it means what you charge during the year is exactly what you must have paid. And what you paid is normally what goes to the cash flow as part of financing. So it means we bring here 600 as the interest paid, So that is it. Otherwise, if there was accrued interest in the balance sheet, then you open the account called interest. You open the account for interest, then you determine the amount we pay. But for this question, there was no accrued interest in the balance sheet, no. So let's get the total of our financing activity items as we come to the end. So this comes to 400 plus 640 plus minus 888 minus 40 minus 600. I'm getting a net of 488 negative. And if it's a negative, we normally call it net cash outflow. We normally call it net cash outflow from financing activities. Net cash outflow from financing activities. Then we normally get the totals of the 3 categories. You remember our category of operating, I can see the figure here. We got 1784. Our investing was 786. So let's get the total of the 3 categories. 1784 minus 784 minus 488. I'm getting a net of 512, and it looks like a positive. Because it's a positive, you call it increase in cash and cash equivalent. Increase in cash and cash equivalent. Then we say you bring down, or you now come and add opening. You come and add opening cash and cash equivalent. Opening cash and cash equivalent. So let's go to the balance sheet last year, or the statement of financial position last year, and we pick all the cash and cash equivalent items. From the balance sheet last year, among the cash, last year we had cash of 8 million. I told you that financial asset at fair value is also considered as part of cash equivalent. So this is where now you use it, because an investment, a short-term investment, is considered as part of cash and cash equivalent. So we go to the balance sheet last year and find out what was the financial asset last year. From this question, the financial asset was not there. So for the purpose of remembering, let me just add 0 for purpose of remembering that there was a financial asset of 0. Then we come and say, could there be an overdraft? Because an overdraft is also part of cash and cash equivalent. From this balance sheet, among the current liabilities, there was an overdraft of 784. You know an overdraft is a negative. You know an overdraft is a negative. So we take 8 million, we minus 784. That leaves me with an opening cash and cash equivalent, which is negative 776 million. That's a negative. Then we get the net. I'm getting 264 million. 264 million and a negative also. That is the figure we call closing cash and cash equivalent. Closing cash and cash equivalent. Let's confirm whether it's agreeing with the closing cash balance that we are given by end of this year. And according to the balance sheet or statement of financial position, by end of this year, we had cash of 16 plus a financial asset worth 400 million. We minus the overdraft because an overdraft is a negative, and our overdraft was 680 million. So let's see whether it's agreeing. Yes, that is agreeing now. So we are through with that question. We are through with that question. And now it brings me to the end. It now brings me to the end of this question. So this is the question of November 2015 from your past papers of advanced financial reporting. This is the question of November 2015. We have seen it's question number 3. So next time we shall do other examples which may involve something different, but the concept is now we have the concept. Together with what we did in the previous class to introduce the concept, now with this illustration, then now you can do. Now, from your past papers, this question of November 2015 was very similar to November 2016 question. If you have your past papers, you can look at that question of November 2016, that question. If you have your past papers, it is also very similar to a May 2014 question, So those 3 questions, if you manage to do this, then you can do the other ones. You can also do the other ones. So on your own, you can attempt November 2016 question on your own. You can also now attempt May 2014 question. Those are questions that are very similar to this, very, very similar. You should be able to do them. The concepts are exactly the same. What they have only done is to change the figures, but they have not changed the concept. So what we shall do next time, we shall do another question which has some different concepts, which may have some different concepts. Otherwise, for those 3 questions, the one we have done and the May 2015, the November 2016, sorry, and the May 2014, I'll say they are very, very, very similar. What they have only changed in their exams is the figures only. It's the figures only. So you can do the other questions. Also for practice now, they follow the same concept except change of figures. So see you next time when we shall do now a question with some more concepts where they are testing some more concepts. So see you for now. Bye.